Our portfolio is broken down into three buckets. The first bucket being global leaders in their respective industries. The second bucket being companies which are out of the spotlight. And the third bucket being companies which are long controversy or taking headline risk. Now, historically, we found most of our opportunity and where we can create most of our value added for shareholders is in that third bucket, which is the companies that are long controversy. Now, this long controversy or headline risk has created very reasonable valuations and low multiples, which have really enabled us to buy these companies at reasonable prices and hold them for the long term and add a lot of value to our shareholders. Now, what's interesting today is we're finding some excellent valuations in some large capitalization companies which are global leaders, which is that first bucket. And those valuations aren't surrounded by controversy. Some of these companies are companies such as a General Electric or a Walmart or a Procter & Gamble or companies like a Microsoft, and that's just to name a few. But these companies aren't around a cloud of controversy and are selling at some reasonable valuations. So we're really finding unique opportunity in these global leaders that we haven't found in the last 3, 5, and even 10 years. Now, this is unique to us because we haven't seen this before, and this has really created a focus on global leaders selling at reasonable valuations rather than looking as much at the controversial stocks out on the market. Last year, I had done a similar update on the portfolio we're managing on behalf of HSBC and spoke about the risks or concerns we saw in the market at that point, that being derivatives, geopolitical, and high levels of debt on the consumer. Now, those concerns are still overlying theme of what we are considering or what we are worried about for the long term. But we have to understand that, or what we'd like people to understand, is that our investment discipline and our investment horizon is one of long term. We're going to own these holdings in our portfolio for long periods of time, and that's reflective of the turnover in our portfolio being so low. Now, in saying this, we're going to own these holdings and our portfolio is going to be positioned to weather different geopolitical environments, different macroeconomic environments, and on the premise that really the future is unpredictable. Now, we're going to own these positions through increasing interest rates, decreasing interest rates, an increasing unemployment environment, a decreasing unemployment environment, and so forth and so on. So we really want to make sure that our portfolio is an all-weather portfolio. Now, we're constantly trying to decipher short-term noise from economic data that comes out, it seems like, on a daily and weekly basis, which we believe is a lot of noise coming from different reports and the media as well. But we're also trying to understand what is the market signal and what is real and what's going to affect our portfolio and the businesses within. Now, those are things such as unemployment, interest rates. As interest rates go up, this obviously has an effect on consumer spending, which is something that is very important to us. As oil prices increase, if you look at it, for every $1 increase in oil prices, it accounts for an approximate $8 billion tax on the consumer, an equivalent of an $8 billion tax, which is a very big number. And this effect on the consumer is something that we take into account, and we try to quantify these things. It's very important that we take into account anything which affects the consumer in the U.S. economy, because the consumer accounts for 70 or approximately 70% of the U.S. economy. So in doing this, we really try to create an all-weather portfolio and try to quantify different things such as oil prices, unemployment, and interest rates in buying and selling businesses and holding those businesses for the long term. Altria, the old Philip Morris, has been a holding that really has created the most dollar added value on behalf of our shareholders. We initially purchased Altria at 6 times earnings in 1998. When the market was trading, the S&P was trading at 18 times earnings. We bought it under a cloud of concern with the Engel case in Florida, which created this very low multiple on the company. And really, the appreciation over time with Altria has been because of the improving regulatory environment. Also, we are very pleased with Lou Camilleri, who took over from a very good CEO in Jeff Bible. And really what we were impressed with was his intention of breaking up the company and willing to break up the company for the domestic tobacco business to trade separately from the international tobacco business and to spin off Kraft. Now, we weren't sure if he was going to do that and he was going to succeed in having that done, but we were very comfortable with his intention to add a lot of shareholder value. So that's one company that has done really well for us. JP Morgan, or what could be referred to as the new JP Morgan, is a company that has done very well for us. It is a classic example of a new management taking over an undermanaged franchise. Now, Jamie Dimon, the current CEO, is one of the best CEOs, or who we consider one of the best CEOs in America today. He's a man with tremendous integrity and is really willing to do whatever it takes ethically to add a lot of shareholder value. He's willing to add quality personnel and management teams in order to run the businesses properly. He's implemented a cost savings program in order to really get costs in line with running a business efficiently and implementing systems as well. And he's also aligning compensation in order to pay people and employees and management in line with the long-term performance of the company and in line with what's in the best interest of shareholders. Golden West Financial has been a wonderful investment for our shareholders, and we've made a lot of money over not so long period of time. It is a company that has recently sold to Wachovia Securities. Golden West sells adjustable rate mortgages to two main areas, that being California and Texas. Now, founded in 1968, it has compounded at 18% per year. It's up almost 180-fold over a 38-year period, which makes that an extremely impressive, consistent, well-managed company, which has really added a lot of value and given great returns to the shareholders who've owned the company. Now, what we really admire about Golden West is the fact that they really take pride in focusing on execution. While a lot of people and a lot of business analysts always tend to gravitate towards strategy and what a company's strategy may be, a lot of the time execution is neglected, and Golden West spends most of their time on execution. Another thing they're focused on is their business culture. The fact that they have their own appraisers that are appraising the mortgages that they're giving out, and they're never willing to give a loan that they don't feel that their customer or prospective customer is going to be able to pay back if interest rates go up. So that culture is something that is very important in their business. And it's almost saying culture over business model, execution over strategy. So in saying this, Golden West has been a very good company for us and has been a very good company for their shareholders over a long, long period of time. And we owe them a debt of gratitude for the great management and what they've done.